Disclaimer: several hundred million troy ounces of this white metal disappeared during recent years. Its market value showed minimal movement. Recently, however, reports indicate silver has surpassed $64 per troy ounce. Industry observers describe this as among the most significant price points in contemporary market records. Those believing the window has closed should reconsider. Multiple professionals suggest we're witnessing merely the initial phase. Based on current reporting, prominent banking institutions acknowledge an emerging technical formation. Various projections hover around $65 with continued upward momentum. Lawrence Leopard, a recognized authority in resource investments, has indicated price levels approaching $75 around the middle of 2026. Additional voices discuss the $100 threshold. This presentation isn't driven by sensationalism. This isn't a manipulative promotional campaign. This concerns identifying a recurring formation, a formation that has replicated itself across economic timelines. Whenever societies diminish monetary value, whenever manufacturing requirements outpace availability, whenever stockpiles decline to dangerous thresholds, valuable metals react. Their movements aren't incremental. They surge dramatically, and observers may be witnessing this development presently. My role isn't that of a certified investment counselor. This content doesn't constitute investment guidance, and no affiliations exist with individuals referenced throughout this presentation. This represents purely instructional examination derived from accessible public records. Those anticipating monetary authorities will intervene and maintain stability should review what's occurring beyond public view. Those expecting technological innovation will miraculously eliminate supply constraints, overlook the basic arithmetic, because these figures are ruthless and calculations remain indifferent to perspectives. A consistent formation exists within resource markets that escapes most people's attention. 4 separate phases: foundation, growth, emergency, detonation. Market chroniclers indicate this formation has materialized numerous times involving silver across the previous 50 years. Current belief suggests we're approaching the 4th phase immediately. Allow me to guide you through this progression. During early 1979, silver was purportedly exchanging near $6 per troy ounce. The Hunt siblings, 2 affluent petroleum investors from Texas, observed something notable. Worldwide silver extraction had remained comparatively stagnant across multiple years. Meanwhile, manufacturing requirements were ascending. Electronics, imaging technology, healthcare equipment all required silver. They began accumulating. Tangible silver, derivative agreements, purportedly countless ounces. Before that year concluded, silver had risen toward $15, subsequently $20, then $30. Around January 1980, silver momentarily reached approximately $50 per troy ounce. Within 12 months, it had expanded roughly tenfold. What caused this? The marketplace recognized actual conditions. Manufacturing purchasers experienced alarm upon realizing availability couldn't maintain pace. Consequently, they began stockpiling, which further restricted availability, which elevated values even higher. A textbook reinforcement cycle. Ultimately, regulatory bodies intervened. They modified regulations during active trading, raising collateral obligations. The Hunt family faced forced liquidation. Values plummeted. However, here's the critical element. The scarcity was genuine. The availability shortfall was authentic. The value surge wasn't merely price manipulation. It represented mathematical response to inadequate supply. Advanced to the final years of the 20th century, the digital revolution. Everyone purchased computing devices, mobile telephones, electronic cameras. Each required silver. Silver compounds in electronic boards, silver in switching mechanisms, silver in connection points. Between approximately 1995 and 2000, researchers observed that worldwide silver requirements from electronics jumped by roughly 40%. Yet extraction from mines barely increased. What explains this? Most silver emerges as a secondary product. It originates from copper, lead, and zinc extraction operations. During periods of depressed copper values, silver extraction naturally decreases simultaneously. Around 1998, according to sector documentation, worldwide reserves began dropping precipitously from roughly 350 million ounces downward to approximately 200 million ounces across merely 3 years. Values climbed from roughly $4 to $7 around 2004. Not explosive, yet consistent and relentless. Subsequently arrived 2008, the economic collapse. Silver spiked toward approximately $21. Why did this occur? Market participants sought tangible assets after finally comprehending silver had maintained a shortfall for almost 10 years. Currently, we reach the present segment. During 2020, the pandemic struck. Distribution networks failed. Extraction facilities ceased operations. Various references indicate worldwide silver extraction declined by roughly 7% from its 2016 maximum. Yet something additional began developing: photovoltaic arrays, battery-powered transportation, fifth-generation wireless infrastructure, artificial intelligence processing facilities, all consume silver in substantial quantities. Sector researchers propose that photovoltaic applications currently represent over 20% of worldwide silver availability. Photovoltaic installation is purportedly doubling approximately every 36 months. Between 2021 through 2025, the marketplace has allegedly maintained shortfalls annually without exception. Not minor discrepancies, considerable ones. Various documentation suggests 2024 experienced a historic shortfall around 280 million ounces, potentially the most substantial recorded. The Chinese government has declared intentions to establish a silver export prohibition commencing during 2026. The Indian subcontinent is acquiring unprecedented quantities. Exchange inventories have purportedly declined to multi-year minimums. Silver has advanced from approximately $18 during 2018 through 20 to exceeding $60 recently. That's purportedly a 250% plus appreciation across roughly 5 years. 3 sequences, 3 surges. Identical formation, identical result. Many believe it's recurring presently. Therefore, where do current conditions stand? Potentially phase 4, the detonation stage. This represents where developments could become compelling. Throughout late 2025, reserves appear to be disintegrating. Documentation suggests exchange warehouses contain less than 300 million ounces, reduced from approximately 400 million merely 24 months prior. London Metal Bank Association storage facilities present a comparable situation. Market watchers indicate Indian price additions have purportedly reached $7 per ounce beyond reference pricing. There seems to be a tangible scarcity. Purchasers are allegedly compensating premiums merely to obtain the metal. Chinese export limitations are anticipated to activate around January 2026. This potentially eliminates among the world's most significant producers from international commerce, retaining everything domestically. Exchange-traded fund accumulations have purportedly increased. Throughout early December 2025 exclusively, silver funds allegedly incorporated approximately 590 metric tons. iShares. Silver Trust is reported to have attained its most elevated position since early 2021. The Federal Reserve recently reduced rates by 25 basis points. Inflation-adjusted returns decreased. The dollar weakened. Both factors historically correlate with favorable silver valuations. Silver lending rates have purportedly escalated. Acquiring physical silver through borrowing is becoming expensive. What explains this? Insufficient quantities appear available for circulation. Manufacturing consumers are rushing to secure availability. The marketplace is beginning to comprehend this isn't a momentary fluctuation. Numerous researchers believe this represents structural transformation. There may exist no rapid solution. You've encountered this narrative previously. Resources boom, subsequently bust. Silver reached $50 during 1980 and collapsed. It reached $49 during 2011 and collapsed. Therefore, why might current circumstances differ? During 1980, silver requirements were predominantly driven by imaging technology and speculative activity. When the Hunt family was forced out, requirements disappeared. Imaging technology ultimately became outdated. Contemporary requirements aren't speculative, they're manufacturing-based. Photovoltaic arrays require silver, and specialists assert no economically practical alternative exists at scale. Battery-powered vehicles require silver. Artificial intelligence processing facilities require silver. Fifth-generation wireless networks require silver. Healthcare equipment requires silver. These sectors aren't disappearing, they're expanding, and availability cannot easily respond. What's the explanation? Silver is predominantly a secondary extraction metal. An estimated 70% originates from copper, lead, and zinc extraction operations. Unless those primary metals experience massive value increases, silver extraction won't expand proportionally. Even if dedicated silver extraction operations commence, sector specialists indicate it requires 7 to 10 years. By that point, the shortfall could consume another billion-plus ounces. Critical elements supporting this hypothesis. First, Chinese export prohibition implemented. They purportedly require it for their photovoltaic infrastructure and electrification objectives. This potentially removes a substantial portion of availability from international commerce, and no clear alternative exists. Second, monetary strategy. The Federal Reserve has recently reduced rates multiple times. They're introducing liquidity to stimulate economic performance. When currencies deteriorate, tangible assets historically tend to appreciate. Gold, silver, commodities. It's a thoroughly documented monetary occurrence. Silver, unlike gold, has manufacturing utility, so it potentially gains from both monetary deterioration and tangible scarcity. A dual favorable force. Third, mainstream recognition deficit. Most market participants don't possess silver currently. Gold, certainly. Equities, absolutely. However, silver, barely anyone according to marketplace information. When mainstream recognition materializes, When prominent financial media begins comprehensive coverage, when individual investors begin inquiring about it, the purchasing could accelerate substantially. There may exist insufficient tangible silver to satisfy that demand increase. Technology will identify a replacement. People stated this regarding copper, lithium, rare earth elements. It predominantly didn't materialize at scale. What's the explanation? Silver possesses distinctive characteristics. It maintains the greatest electrical transmission of any metal, the greatest thermal transmission. It's antimicrobial. It's highly light reflective. You cannot simply substitute it across most applications. Certainly, researchers are attempting to decrease silver utilization in photovoltaic arrays, thinner compounds, substitute materials. However, even if they succeed, researchers propose it might merely decelerate requirement growth, not reverse it. Photovoltaic applications represent just one component of silver requirements. Battery-powered vehicles, fifth-generation wireless, artificial intelligence, healthcare equipment are all expanding. Even if photovoltaic utilization declines by roughly 10%, alternative sectors could absorb the difference. What about material recovery? Recovery purportedly contributes approximately 200 million ounces annually, yet it's not expanding sufficiently rapidly. What's the explanation? Most silver is utilized in minute dispersed quantities. Electronic boards, photovoltaic arrays, healthcare equipment. It's costly to extract, and most products don't undergo recovery until end of useful life. Photovoltaic arrays last approximately 25 years. The arrays installed during 2010 are just now entering the recovery pipeline. Before recovery increases substantially, the shortfall could consume billions of additional ounces. What about monetary authority manipulation? Paper agreements don't matter significantly when there's a legitimate tangible scarcity. If you require silver for your photovoltaic manufacturing facility, you cannot utilize a derivative agreement. You require tangible metal. When tangible purchasers begin competing intensely, the paper marketplace can fracture. We observed something comparable with nickel during 2022. Value controls failed. The marketplace froze. Values went vertical. Therefore, where could this potentially advance? Here's what various researchers are proposing. First quarter 2026, $65 to $70. Various prominent banking institutions have projections in this range. If Chinese export limitations activate and tangible constraint intensifies, fund accumulations could continue. Manufacturing purchasers might experience alarm and begin securing availability at any valuation. If silver breaks beyond the upper 60s, various technical researchers suggest there's minimal resistance until the middle 70s. Second quarter, 2026, $70 to $80. This is purportedly Lawrence Leopard's projection zone, approximately $75 around middle 2026. The logic? If 2026 maintains another estimated 150 million ounce shortfall, reserves could decline to what some consider dangerously minimal thresholds, potentially beneath 200 million ounces internationally. That might represent less than 60 days of availability. When reserves fall that minimal historically, marketplaces can fracture. Values don't move in small increments. They gap. 10% movements in one day, 20% movements in 7 days. If mainstream media begins comprehensive coverage and individual investors accumulate, the momentum could become self-perpetuating. Third to fourth quarter 2026, $80 to $100, or potentially higher. If photovoltaic installation continues at present rates, various forecasts propose 2027 requirements could approach 800 million ounces. Availability perhaps around 850 million ounces if recovery increases. That's a razor-thin margin. Any disruption, any extraction facility closure, any additional manufacturing requirements, and the marketplace could enter emergency status. Various researchers at institutions like BNP Paribas and Solomon Global have purportedly discussed $100 projections by end of 2026. Technical researcher Michael Oliver's momentum systems have proposed even greater thresholds could be possible. Some have referenced ranges of $150 to $200 if the breakthrough accelerates dramatically. Is that plausible? Well, if silver reaches $100, that would represent approximately a 58% appreciation from present thresholds. Gold climbed from around 1,800 to approximately 2,700 across 24 months. That's roughly a 50% appreciation. Gold doesn't have the identical availability shortfall situation that silver purportedly has. Therefore, what could you potentially execute with this information? Here are 3 common approaches market participants consider. First, tangible silver coins, bars maintained outside the conventional banking infrastructure. You possess the actual metal, no intermediary risk, no paper agreements. Considerations: additions over reference pricing, storage logistics, liquidity constraints. However, if the hypothesis materializes, tangible silver could serve as strong portfolio insurance. Second, silver exchange traded funds. Options include iShares, Silver Trust, Aberdeen Standard Physical Silver, Spratt Physical Silver Trust. These purportedly maintain tangible metal. You can purchase and liquidate relatively instantly. Considerations: good liquidity, no storage complications. However, there exists intermediary risk. If the financial infrastructure experiences severe stress, fund functioning could be affected. Third, silver extraction companies. This is often considered the amplified position. When silver valuations rise, extraction companies' profits can multiply substantially. A 10% movement in silver might translate to a much larger movement in extraction stocks. Companies like First Majestic, Pan American Silver, Hecla Mining, and Kerr Mining are names that surface in discussions. Warning: extraction operations carry operational risk, labor disruptions, cost escalations, geopolitical complications, management quality. They're more volatile. Alternatively, naturally, execute nothing. Assume the formation breaks this occasion. Assume availability miraculously appears. Assume technology resolves everything overnight. However, if you're incorrect, you miss the potential movement. If silver does reach substantially higher thresholds, you'd be observing from the periphery. Marketplaces rarely move in straight trajectories. Silver will likely have retreats, adjustments, days where it drops 5 or even 10%. When that occurs, many people panic. They declare the breakthrough failed. They say it's concluded. However, historical formations suggest looking past short-term volatility. If the structural shortfall is genuine, if reserves remain minimal, if requirements stay secured, then retreats might represent opportunities rather than catastrophes. Because the fundamental arithmetic doesn't change with daily value fluctuations. Hundreds of millions of ounces purportedly gone, another substantial shortfall potentially arriving in 2026, and limited new availability anticipated for years. The risk-reward calculation: many researchers view this as among the most asymmetric configurations in commodities currently. The downside: perhaps silver retreats to the middle 50s. The upside: potentially $100 or more according to various forecasts. That could represent favorable risk-reward ratios, possibly 5 to 1, maybe even 10 to 1. For thousands of years, humans have utilized silver as currency, as a value repository, as a protection against monetary deterioration. Throughout history, every time a civilization expanded its monetary supply aggressively, every time manufacturing requirements surged, every time availability couldn't maintain pace, silver has responded explosively. Ancient Rome, the Byzantine Empire, Weimar Germany, the Hunt siblings era, the dot-com boom, and potentially currently. The formation tends to replicate. Why? Because human behavior doesn't fundamentally change. Governments often create money when under pressure. Industries always consume resources, and scarcity historically drives valuations higher. Silver targeting out $75 by middle 2026 isn't merely a random forecast. According to those who examine these formations, it's potentially the subsequent chapter in a narrative that's been written many times throughout economic history. Prominent banking institutions are observing it. Respected commodity researchers are monitoring it. The technical charts are displaying it. The shortfall mathematics appear to validate it. The question isn't whether this formation exists, it's whether you're paying attention to what might be developing. Because if this breakthrough is genuine, it's occurring immediately. While you're reading this, while you're processing this information, this examination is for instructional and informational purposes exclusively. It represents a synthesis of accessible public marketplace information, researcher perspectives, and historical formations. It is not investment guidance.